If you had $100,000 today and had to choose between buying a rental property or investing it all in the stock market, which option would make you a millionaire faster? Many people claim that real estate is the only true way to build wealth. Others argue that the stock market is the ultimate means for generating passive income, but when you crunch the actual numbers, including taxes, maintenance, and the power of leverage, the outcome may surprise you. Today, we will follow two investors over 30 years to see who really comes out on top. The debate between real estate and stocks is as old as money itself. On one side, you have the brick-and-mortar crowd who love the idea of owning something tangible. On the other side, there are the liquid asset advocates who prefer the convenience of clicking a button to own a piece of the world's most profitable companies. To uncover the truth, we need to look beyond the hype and examine the hard data. For this purpose, let's consider the lives of two friends named Alex and Sam. Both are 30 years old and have just inherited $100,000. Both share the same goal, reaching financial independence in 30 years. Alex is a real estate guy who believes in leveraging physical assets. Sam is a stock market girl who values simplicity and the long-term potential of the S&P 500. For his opening move, Alex decides to invest his $100,000 as a 20% down payment on a $500,000 single-family home in a desirable suburb. It is important to remember that he does not yet fully own the house. He holds $100,000 in equity, while the bank owns $400,000. This strategy is known as leverage. Although Alex incurs expenses such as closing costs, inspection fees, and some initial repairs, we will assume he finds a turnkey property for the sake of this analysis. His monthly mortgage, taxes, and insurance total about $3,000. He rents the house out for $3,500 a month, giving him an apparent cash flow of $500 each month. Meanwhile, Sam takes her $100,000 and opens a low-cost brokerage account. She purchases an S&P 500 index fund. She does not have to interact with a bank, pay a realtor, or even leave her couch. Her work is finished in just 5 minutes. She now owns a small portion of Apple, Amazon, Tesla, and 497 other major companies. In the first few years, Alex feels very confident about his investment. However, the reality of being a landlord soon sets in. In year 3, the air conditioning breaks down, resulting in a $6,000 bill. In year 4, his tenants move out, leaving the house empty for 2 months while he cleans it and finds new renters. Alex comes to understand that cash flow does not always equal profit. He has to set aside 10% of his rent for maintenance and another 5% for potential vacancies. His $500 monthly profit starts looking more like $200. Sam faces a different challenge: emotional stress. In year 2, the stock market drops by 15%. She watches her $100,000 investment shrink to $85,000 on her phone screen. Friends urge her to sell before she loses everything. However, Sam understands the numbers. She does not have to fix a toilet or chase anyone for rent. She ignores the news and allows the dividends to reinvest. By year 5, the market has recovered, and her $100,000 has grown to approximately $146,000, assuming an 8% average return. This is where the math gets interesting. Alex is using leverage. Even though the housing market typically grows by only 3 to 4% per year, Alex benefits from that 4% growth on the entire $500,000 house, rather than just on his $100,000 investment. If the house increases in value by 4%, that results in a $20,000 gain. Compared to his original investment, this translates to a 20% return on his cash. This is why real estate is often referred to as a wealth accelerator. On the other hand, Sam is relying on pure compounding. She does not use leverage, but she achieves higher average returns, which are historically around 10% for the S&P 500 before inflation. Additionally, she faces no friction, meaning she does not have to pay property taxes or 6% agent commissions each time she wants to assess her investment value. By year 15, both investors face new challenges. In Alex's situation, the neighborhood has improved, and the house is now valued at $850,000. His mortgage is halfway paid off, and his rent has increased to $4,500. Although he is making decent money, he has spent a total of 500 hours over the last 15 years managing contractors, tenants, and paperwork. His real estate investment feels more like a part-time job. Sam has not spent a single hour working on her investment. Thanks to the power of compounding, her $100,000 has grown to approximately $417,000. She has avoided the stress of leaky roofs, though she has had to endure 2 major market corrections in which her net worth temporarily dropped on paper. By year 20, both Alex and Sam discover a secret weapon that accelerates their wealth. Alex realizes that his single-family home has appreciated significantly. If he sells it outright, he will incur a substantial tax burden on the capital gains. Instead, he utilizes a 1031 exchange, which allows him to sell his house and reinvest the entire profit into a larger $1.2 million small apartment complex without paying any taxes at that moment. Now, instead of receiving rent from one family, he is earning rental income from 4 families. This strategy illustrates how real estate moguls trade up to build extensive portfolios. He is still leveraging his original investment, but is now controlling a much larger empire. Sam does not need to trade anything. Instead, she focuses on something called dividend growth. The companies in her index fund are not only increasing in share price, but also paying out cash dividends. In the early years, her dividends amounted to only a few $100s. However, by year 20, her dividend snowball has grown significantly. She is now receiving thousands of dollars a year in dividends, which she automatically reinvests to purchase even more shares. This process happens seamlessly while she sleeps. She does not need to search for a bigger stock because the stocks she already holds are doing all the work for her. This is where we see the most notable difference in the psychological edge. Alex's wealth is active. He has to make significant decisions, communicate with lawyers, and manage transitions. It is high stakes and high reward. On the other hand, Sam's wealth is passive. Her biggest challenge is not the paperwork, but the boredom of doing nothing. In the financial world, being boring is often the most profitable strategy. To understand who comes out ahead, we need to examine the wealth eaters known as expenses. Real estate expenses include property taxes, which are typically 1 to 2% of the home's value each year. There's also maintenance, where the 1% rules suggest spending about 1% of the home's value annually on upkeep. Insurance is necessary and tends to increase over time. Finally, Alex paid a considerable amount in interest to the bank during those early years. Stock expenses are much simpler. If Sam selected a good index fund, she is likely paying an expense ratio of only about 0.03%. She only pays taxes when she sells, meaning if she holds her investments for 30 years, her money grows tax-deferred. Now it is time for Alex and Sam to retire. Both decide to sell everything and move to the beach. For Alex's final numbers, the house, after 30 years of averaging a 4% appreciation, is now worth approximately $1.62 million. He has paid off the mortgage and owns it free and clear. However, he must pay selling costs, which average about 6%, or $97,000. He also faces capital gains tax under current law. After subtracting his original investment, 30 years of taxes, and maintenance costs, Alex's net wealth from this one property is roughly $1.2 million. Sam's index fund, averaging a 10% return, has grown to an impressive $1.74 million. Her selling costs are zero because selling stocks is just a click of a button. She will owe long-term capital gains tax, typically 15 or 20% in the United States. After taxes, Sam walks away with approximately $1.4 million. On paper, Sam is the clear winner. She has more money and did not have to do any manual labor. However, the real math is not always that straightforward. Real estate might actually be the winner for some because of forced savings. The house acts as a forced savings account because Alex has to pay his mortgage each month. Sam could have easily skipped payments or sold her stocks whenever she wanted cash for a new car. Many people lack the discipline to hold on to stocks for 3 decades. Real estate also provides depreciation benefits, allowing Alex to inform the tax authorities that his house was losing a value on paper, thereby reducing his tax liability on his rental income. Furthermore, Alex received monthly rental checks for immediate cash flow, while Sam's money was locked in the market. On the other hand, stocks might be the winner because of liquidity. If Sam faced an emergency, she could sell $10,000 worth of her stocks and have cash within 48 hours. Alex would need to take out a loan or sell the entire house, which could take months. There is also the benefit of diversification. Alex's entire investment was tied up in one house in a single location. If the local economy crashed, his house value could plummet. Sam owned shares in the top 500 companies in the country. Finally, stocks scale efficiently. It is challenging to buy 100 houses, but purchasing millions of dollars worth of stocks is relatively simple. The real math indicates that both paths lead to wealth, but they require different personality types. Choose real estate if you enjoy being an entrepreneur and like using the bank's money to grow your own. Choose stocks if you want a truly passive lifestyle and have the emotional discipline to watch your net worth drop by 30% in a single month without panicking. The pro move is that most wealthy individuals do not choose one over the other. They use cash flow from their businesses to invest in stocks, and they use the stability of their stock investments to eventually purchase real estate. None of this matters if you do not start. The 30-year clock only begins when you put your first dollar to work. Whether it is a down payment on a property or an investment in an index fund, the winner is always the person who starts earliest. So, are you team real estate or team stocks? If you are just starting with your first $1,000, check out our next video where we break down the best lazy portfolio for beginners. Do not forget to hit the like button if this information helped you see the bigger picture. I will see you in the next one.